It's the 23rd of November 2025, and this is BD Daily Tech News Podcast, your daily briefing on technology, markets, and innovation.
Today, we're tracking a huge slate of AI and big tech stories, from Tesla's next-generation AI chips to a billion-dollar AI bet in Africa and a looming decision over whether Google's Adtech empire gets broken up.
Here's the rundown for the 23rd of November 2025. First, Elon Musk says Tesla is nearing tape-out of its in-house AI5 chip and has already kicked off work on AI6. Second, the United Arab Emirates plans to invest $1 billion to expand AI infrastructure across Africa, aiming to close a massive data and compute gap. Third, a U.S. judge who already found that Google holds a monopoly in online ad tech is now asking how fast a breakup remedy could be enforced. And finally, markets just lived through a volatile week as AI and crypto anxiety hit investors, with Bloomberg's tech team calling out some of the choppier trading since March.
We'll keep this tight but deep, so if you're listening on YouTube, use the chapter markers to jump around, and don't forget to subscribe so you don't miss our daily briefings.
Let's start with Tesla and those AI5 and AI6 chips, because that's really about who owns the future of AI compute. On Sunday, Elon Musk posted on X that Tesla is, quote, nearing the final step of the design process for its AI5 chip and has started work on an AI6 chip to be deployed in its cars and data centers.
That phrase, nearing the final step, usually means tape-out, which is when the design is frozen and sent to a foundry like TSMC to manufacture. From that point, you're typically looking at several months before you see volume silicon.
Tesla already has Dojo, its in-house training supercomputer, and the FSD computer inside cars. What's new here is the suggestion that AI5 and AI6 could be a full-stack play, covering both in-vehicle inference and back-end training in Tesla data centers.
Right, and this comes as Nvidia's dominance is under pressure from export controls. We've seen multiple reports this month about U.S. regulators weighing which high-end H-series chips can ship to China or the Middle East, and that uncertainty is a big incentive for large AI players to design their own silicon.
We also saw a separate news item that 4 people, including a tech company CTO, were indicted for illegally exporting Nvidia chips to China, which underlines how sensitive these accelerators have become.
Exactly. AI chips are now treated almost like strategic commodities. That's why Musk wants Tesla to have more control, especially when he's promising investors millions of robo-taxis and a humanoid robot program that could each require tens or hundreds of exaflops of compute over time.
To put that in perspective, some estimates put Tesla's current Dojo plans in the low exaflop range, while hyperscalers like Google have talked about needing thousand-fold capacity increases over 5 years just to keep up with AI demand.
Google's own AI infrastructure chief reportedly told employees that they need to double capacity roughly every 6 months and increase it 1,000-fold in 5 years. If that's the bar, Tesla has to either buy a lot more Nvidia or build something that's extremely optimized for its own workloads.
Investors will ask a simple question: does this actually save Tesla money versus just buying GPUs? Or is it about strategic independence and product differentiation, like Apple's move to its own M-series chips?
Most likely both. If AI5 delivers, say, 20 to 30% better performance per watt for Tesla's specific self-driving models, that could reduce data center operating costs and allow more inference to be done on the car, which reduces latency and cloud bills.
But there's execution risk. We've seen other custom chip efforts slip, and Musk is famous for aggressive timelines. So when he tweets about AI6 already starting, how seriously should we take that from a timing standpoint?
I'd treat AI5 as the near to medium-term product and AI6 as a signal of ambition. Historically, Tesla's autopilot and FSD timelines have often been late by 1 to 2 years versus initial promises, so I'd mentally discount any implicit schedule by at least 50%.
For listeners who are developers or founders, one takeaway here is that the AI stack is stratifying. Hyperscalers, big consumer platforms, and now auto companies are all trying to own their own chips, which could reduce the addressable market for third-party accelerators over time.
And it also means that skills in hardware-software-co-design, from low-level CUDA-like programming to model compression and quantization, are going to stay very valuable because everyone is trying to squeeze more out of each watt and each square millimeter of silicon.
Let's park Tesla there. We'll circle back to AI chips when we talk about market volatility later in the show, because Nvidia and export rules are a big part of that story. Next up, the UAE is planning to invest $1 billion to expand AI infrastructure and services across Africa, aiming to bolster its influence on a continent that's lagged the rest of the world in adopting the technology.
That figure, $1 billion, is big enough to build multiple regional data centers, lay fiber, and seed local AI startups. Remember, some estimates say Africa currently hosts less than 2% of global data center capacity, despite having about 18% of the world's population.
The UAE has been extremely active in AI geopolitics. Abu Dhabi-backed groups have invested in AI labs and chip ventures, and this move extends that strategy into infrastructure on another continent.
For African economies, the upside is access to modern compute. Training a state-of-the-art model can cost tens of millions of dollars, and even running mid-size models at scale requires GPUs and power that many local firms just don't have today.
We've also seen climate tech investors argue that now is the best time to invest in green infrastructure. If this $1 billion goes into AI data centers that are energy efficient and tied to renewables, it could align with that thesis.
Yes, and climate is not a side issue. AI data centers are power-hungry, and big buyers like Meta are literally looking to get into electricity trading to accelerate new power plants for their data centers. So any African AI build-out has to be paired with serious grid planning.
There's also a strategic angle. Africa has been a focal point for Chinese infrastructure investment for over a decade. Now you have the UAE stepping in on the AI side, and Western governments talking about critical minerals and supply chains.
Exactly. The UK just announced a plan to domestically produce 10% of its critical minerals needs to reduce reliance on fragile global supply chains. In parallel, whoever helps Africa build data centers, fiber, and AI talent gets influence over digital standards and cloud providers.
For founders and engineers in African cities like Nairobi, Lagos, or Cape Town, having a local or regional AI data center could cut latency dramatically from hundreds of milliseconds across continents to tens of milliseconds locally, which matters for everything from fintech to gaming.
And it can reduce the cost of compliance. If you can keep data in-country or in region, it's easier to meet emerging data protection rules while still using large models, instead of having to ship everything to Europe or the US.
What risks should we flag beyond the usual project execution risk that any big infrastructure plan faces?
Two stand out. One is governance, who controls the data centers, the encryption, and the logs. The other is sustainability. If this $1 billion just adds data centers powered by coal-heavy grids, it could worsen emissions at a time when global expectations around climate policy have shifted sharply in the last decade.
We'll keep tracking how that $1 billion gets allocated, because the details, how much goes to fiber, how much to GPUs, how much to talent, will determine whether this is a headline or a real inflection point. Let's shift to Google and Adtech, where a US judge is edging closer to a decision that could actually force a breakup of parts of Google's advertising business.
On Friday, both sides made closing arguments in the Justice Department's case, accusing Google of illegally monopolizing the Adtech market. Earlier this year, Judge Leonie Brinkema already ruled that Google holds a monopoly in online ad tech.
What's new now is the remedy phase, and Reuters reports that the judge asked the DOJ how quickly an anti-competitive measure could go into effect, adding the phrase, quote, "time is of the essence."
That's important because Google is expected to appeal. And the judge also noted that a remedy, such as forcing Google to sell its ad tech subsidiary, might not be easily enforceable while an appeal is pending. So she's clearly thinking about timing and how to avoid a multi-year limbo.
Google's attorney, Karen Dunn, argued that a forced sale would be extreme and would hurt customers. On the other side of the Atlantic, the company is facing a potential $3.5 billion fine from the EU over similar ad tech antitrust issues.
So you have this convergence. US and EU regulators both focusing on the same core stack, Google's tools for publishers, advertisers, and the exchange in the middle, and both saying one company controlling all layers creates conflicts of interest.
For everyday listeners, why does this matter beyond Google's stock price? How could a breakup change the ads you see or the revenue for websites you visit?
If Google had to spin off its ad server or exchange, you might see more competition in fees. Some studies have suggested that ad tech middlemen can take 30 to 50% of every advertising dollar, so more competition could mean more money to publishers or lower prices for advertisers.
There's also a privacy angle. Google has been under fire for how it uses data across services, and there were viral posts this month accusing Gmail of training AI on your emails, claims Google publicly denied, saying its privacy policy and smart feature settings have not changed in that way.
Right, and while that specific claim was disputed, the broader trend is clear. Regulators are more willing to question data usage, bundling, and dominance, especially as AI models make data even more valuable. This Adtech case is part of that larger shift.
We should also note that this isn't happening in a vacuum. Policy news has been a major driver of market volatility. Historically, one NBER paper found that about 30% of economic policy uncertainty articles discuss tax policy, and another 30% discuss monetary policy, and now AI and antitrust are joining that list.
And on AI specifically, there's a tug-of-war between federal and state regulators. We've seen reports that a Trump administration order targeting state-level AI regulation is on hold, which could open the door for more aggressive state rules if federal policy stays slow.
So, between Google's Adtech case, AI chip export controls, and evolving privacy rules, tech regulation is no longer background noise. It's a first-order risk factor that founders and investors have to model explicitly.
If you're building in Adtech, AI, or social, you need a regulatory narrative as much as a product narrative. That includes thinking about data minimization, opt-in transparency, and how you'd operate if a core platform changed its APIs or business terms under regulatory pressure.
We'll keep you updated as soon as Judge Brinkema issues a remedy decision, because the timing, whether she moves before appeals or waits, will be almost as important as the content of the order. Let's zoom out to markets, where Bloomberg's the 21st of November 2025 tech segment described the past week as a wild ride driven by AI and crypto anxiety.
Bitcoin is on track for its worst weekly performance since March, according to CoinDesk. While U.S. demand indicators like the Coinbase Premium have weakened even as spot ETFs in the U.S. reach new asset milestones.
On the AI side, investors are trying to reconcile enormous capex plans. Google talking about thousand-fold capacity growth, Microsoft and others signing multi-billion-dollar data center deals with questions about monetization and regulation.
Bloomberg highlighted 3 pressure points this week. First, uncertainty over U.S. approval for advanced AI chips to be sold to the Middle East. Second, OpenAI teaming up with Foxconn to design AI data center hardware in the U.S. And third, ongoing debates about how much AI spend is sustainable if enterprise adoption slows.
Layer on top of that, the crypto side, Bitcoin's weekly drop, weakening demand indicators, and a general risk-off mood, and you get the kind of intraday swings we saw across tech names this week.
For context, when Bitcoin has had weeks like this in the past, down sharply with negative ETF flows, you often see 20 to 30% drawdowns in smaller altcoins. And that can spill over into broader risk sentiment, including high multiple AI stocks.
So, how should a tech-focused investor or even a startup employee with equity think about this mix of AI exuberance and crypto anxiety on the 23rd of November 2025?
First, separate long-term theses from short-term volatility. The structural trend, more compute, more AI in products, more on-chain experimentation is still intact, but the path is noisy and policy headlines can move prices 5 to 10% in a day.
Second, watch real economy adoption metrics. For AI, that's things like enterprise seat counts, attach rates in productivity suites, or AI revenue disclosure in earnings. For crypto, that's on-chain transaction volume, stablecoin flows, and ETF inflows or outflows.
And third, diversify your exposure. If your job, your startup, and your portfolio are all concentrated in the same narrow slice of AI or crypto, you're effectively leveraged to one narrative, which is risky in a week like this.
We've also seen some idiosyncratic tech news that feeds into confidence and risk perception, like Harvard investigating another database breach after a phone phishing attack and ongoing Ivy League cyber incidents, reminding everyone that security remains underinvested in.
Those breaches matter because they can accelerate spending on cybersecurity, but they also highlight operational risk. When universities and hospitals get hit, regulators and insurers often respond with stricter requirements that ripple into enterprise IT budgets.
So you have this strange mix. AI infrastructure names talking about exponential growth, crypto taking a hit, cyber risk rising, and regulators circling big ad and AI platforms all in the same macro soup.
For listeners, the practical move is to shorten your news reaction cycle, but lengthen your investment horizon. Check how stories like AI chip export rules or Google's Adtech case affect your thesis. But don't let every headline push you into panic trades.
And if you're a founder, this environment rewards clarity. Investors are asking harder questions about unit economics, regulatory exposure, and capital intensity, especially in AI, infrastructure, and crypto, so be ready with crisp answers.
One last point on volatility. Social media still shapes sentiment. Pew's latest report found that X is still used by 21% of U.S. adults, only slightly down from 23% in 2021, despite competition from new platforms, so narratives can still swing fast on that one network.
And Elon Musk himself, according to one analysis, posted over 1,700 times on X in a single month, averaging more than 55 posts a day, which shows how much market-moving commentary can come from one account.
So, between Musk's posts about Tesla's AI5 and AI6 chips and broader macro chatter, it's no surprise that sentiment in both AI and crypto can swing dramatically within hours.
Before we wrap, let's touch on one more autonomy story that connects back to Tesla. Waymo just got regulatory approval to expand fully driverless operations across more of the Bay Area and Southern California.
Waymo said Friday that it's now officially authorized to drive fully autonomously across more of the Golden State. That means more robo-taxis on the road without safety drivers, in parallel to Tesla pushing software-based autonomy with its own AI chips.
Waymo's approach is still heavily LiDAR and sensor fusion with centralized compute in the vehicle, while Tesla is betting on pure vision plus in-house training. Two very different technical bets heading into 2026.
And regulators are watching both. Every new approval for Waymo or Cruise is paired with safety conditions, and any high-profile incident can quickly trigger reviews or suspensions, which is another reason Tesla wants more reliable, optimized hardware like AI5 and AI6.
For cities, the question is whether robotaxis reduce congestion and accidents or just add more empty miles. For investors, it's when these fleets turn from CapEx-heavy experiments into profitable networks.
And for listeners, it's whether you'd actually ride in one. If you're in the Bay Area or SoCal and you try a Waymo this month, let us know in the comments how it compares to a human rideshare driver.
Let's do a rapid-fire consumer tech angle before we close, because a lot of you are thinking about Black Friday deals as well as big-picture AI.
On the AI hardware side, some of the best AR glasses, like Xreal's 1-in-1 Pro, are cheaper than ever during Black Friday. One deal knocks about $50 off the Pro, bringing it to around $599. For a 222-inch virtual display, you can plug into a laptop or Steam Deck.
Streaming devices are also discounted. Amazon's Fire TV Stick 4K Max, one of Engadget's favorite sticks, is down around 41% to roughly $35, with support for 4K, HDR10+, Dolby Vision, Dolby Atmos, and Wi-Fi 6E.
VPNs and subscriptions are another big theme. Proton VPN's 2-year plans are up to 75% off, dropping VPN Plus to about $2.49 per month, and some of the best budgeting apps like Quick and Simplify are running roughly 50% off annual subscriptions.
On the streaming side, Apple TV Plus is offering 6 months for about $36 if you subscribe directly through Apple, which works out to around $6 a month to catch up on shows like Severance, For All Mankind, and Silo.
And one more niche item. Audible has a 3-month deal for around $3 total, essentially $1 per month, which is about an 80% discount off the usual subscription if you want a low-cost way to build an audiobook habit over the winter.
We're not a deals show, but these discounts tie back into the bigger story. AI and data are changing everything from how you watch TV to how you budget, so it's worth being intentional about which tools you actually use.
If you do pick up a VPN, AR glasses, or a new streaming box this week, think about privacy settings and data collection. A few minutes in the settings menu can make a big difference to how much of your behavior gets logged and used for ad targeting.
All right, let's recap what matters most from today's episode for the 23rd of November, 2025.
First, Tesla is nearing tape-out for its AI5 chip and has started work on AI6, signaling a deeper push into custom AI silicon for both cars and data centers, partly to reduce reliance on Nvidia amid export controls.
Second, the UAE's $1 billion AI infrastructure plan for Africa could meaningfully shift where compute lives, who sets digital standards, and how inclusive the next wave of AI adoption will be.
Third, Google's Adtech monopoly case is moving into the remedy phase. with a judge already on record saying time is of the essence, raising the real possibility of a structural breakup and adding to big tech regulatory risk.
Fourth, markets just lived through a volatile week driven by AI and crypto anxiety. Bitcoin on track for its worst week since March, spot ETFs and chip export rules in focus, reminding everyone that policy and infrastructure headlines can hit prices fast.
And finally, autonomy and consumer tech are evolving in parallel. Waymo expanding driverless coverage in California, while Tesla doubles down on AI chips, and Black Friday deals bringing AI-infused devices, VPNs, and subscriptions to mainstream users at steep discounts.
We'd love to hear your take. Are you more bullish or bearish on Tesla's in-house AI chips after today's news? And do you think regulators will actually force Google to spin off part of its ad business?
If you're watching on YouTube, drop a comment with your answer and tell us which AI or subscription tools you're actually paying for heading into 2026 VPNs, AR glasses, streaming, or none of the above.
Make sure you hit subscribe and turn on notifications so you don't miss tomorrow's episode. We'll be tracking any overnight moves in AI, chips, crypto, and the Google case.
And if you found this helpful, share it with a friend or colleague who follows tech and markets. A 20-minute briefing can save them an hour of scrolling.
You've been listening to BD Daily Tech News Podcast for the 23rd of November, 2025. I'm your host. Thanks for spending part of your day with us.
We'll be back tomorrow with more on AI, markets, and innovation. Until then, stay curious and stay informed.
Thanks for listening, and have a great rest of your day.